Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I want to give a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to optimize your investing plan, pay off student loans, or simply build a solid financial plan, YFP Planning will help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Jonathan in Southern California.
Hi, Tim. This is John from Southern California, and I opened a taxable brokerage account as a way to access funds for early retirement. But I started looking at single-family properties outside of California and was trying to get your thoughts on selling assets in the brokerage account and paying capital gains to fund these rental properties. Thanks for all that you do, and I greatly appreciate the show, and have a great week. Thank you.
Jonathan, thank you so much for taking time to submit your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
Yeah, I love this question. And I think to me, before I would get into anything, Jonathan, with you, I would want to look at the balance sheet, look at the goals, see where we're at. I would love to leave the taxable brokerage account alone and try to find an alternative to do this. But to kind of back up, we talk about how to fill your buckets, and what we typically talk about is, in a lot of cases, when you're thinking about retirement, traditional retirement, you want to get your match from your 401k, 403b, and then depending on the 401k and 403b, look at potentially maxing out things like IRAs, Roth IRAs, and then go back into the 401k, 403b, and max those out, which are now, the limit now is $20,500. Sometimes you'll have access to something like a 457, so that's a good bucket to fill. And then you kind of get to this point where you are filling all the buckets, and you're like, what's next? And especially for someone that's looking at early retirement. So let's say, you want to retire at 55. A lot of these accounts that we just mentioned, you can't really, outside of certain exceptions, you can't really access them without a 10% penalty. So if you want to retire at 57 or 55, then, you have to really wait until you're 59 and a half years old until you can get the money without that penalty. So what a lot of people do in early retirement is really the two of the things that Jonathan mentioned here is a taxable account. So basically, you would have a sum of money there that would get you, if you're retiring at 55, through that first 5 years of retirement. So you wouldn't have to necessarily touch the 401k, IRA type of accounts. Or they do something, and this is probably less common, but they do something more non-traditional, which is the real estate piece, where they can liquidate that, or if they've done it nicely, they can live off of the income that's being produced from the real estate. So the nice thing about real estate in the sense is that it's something that can produce cash for you today, but then it also can appreciate over time, and there's tax benefits and things like that. So in your case, Jonathan, I would say, yeah, I would love to look at the balance sheet and the assets that you have to be able to avoid liquidating the portfolio and paying the capital gains. To back up, capital gains tax exists in taxable brokerage accounts, unlike a 401k, IRA, where the assets grow tax-free, meaning, if you buy that mid-cap mutual fund in your portfolio in your 401k and you buy it at 10 and it grows to 60, you would pay no capital gains on that $50 per share appreciation. But in a taxable account, you would pay capital gains tax, which would be anywhere from 0 for lower tax brackets, 15% for most pharmacists out there, and 20% for higher tax brackets. So that's one of the big benefits of the 401k IRA, because you don't have that 15% tax. It grows tax-free inside of the account. So I think the big question that I would ask you, Jonathan, so ask a YFP CFP, and kind of turn the tables a little bit, is, what's your appetite for that? Are you an experienced real estate investor? A lot of people get into real estate thinking it's like very passive. It's really not. And I would definitely be tuning into Nate, Hedrick, and David on the real estate side of things, their podcast, because there's some people that can build it out very, very passive, and some people it's what they're going to be doing day in and day out. So they're very, very different types of investments. So then how does that fit in with your career and the rest of your portfolio that you have built, being built? The other thing is just like the taxes related to that. So again, in a traditional portfolio, a brokerage account, you're going to pay capital gains rates on any growth over time. For real estate, it's going to be different. So you're going to be earning income as you go if you do it right. So when you purchase a property and you rent it out, if you're renting it, you'll pay taxes on the net rental income. So basically that means that the income less anything that you can subtract expense wise. So it could be property management, maintenance of the property, that type of thing. And that rental income is taxed at the same rate as your ordinary income, the same as what you would have through your job. In terms of a sale, if you sell a real estate investment property, it also generates capital gains that is above and beyond like your cost basis. So let's pretend I buy a property for $100,000 and then I put another $20,000 in it. My basis is $120,000. So then if I sell it for, broad numbers, $200,000 in the future, then I would pay $80,000 in cap gains taxes. And if it's long-term, meaning more than a year, it'd be more preferable to be that 0, 15, and 20%. And then there's also another thing called a 1031 exchange, which allows you to basically swap out an investment property for like a similar property and defer paying capital gains, which is a huge benefit for real estate investors, when they go to, liquidate a property or at least swap out a property. So Jonathan, longer answer, I would say that depending on what your goals are, depending on what your appetite for risk is, I think that either one of those roads are viable. And again, even in real estate, you're talking about single family properties. Sometimes that can be a slower go of things versus like a multi-family or something like that. So even the strategy behind, in the pivot that you're making, I think is worth examining and questioning. And I think, you can do it in the traditional investment and you can do it more in the non-traditional, the real estate. It's just a matter of lining up then the goals, the resources that you have in terms of income, in terms of savings, in terms of the investments that you have, and then directing that more intentionally towards what you're trying to achieve. And I think modeling those two things out, those two kind of paths, and maybe even a hybrid path is definitely worth doing, depending on where you're at in your process.
Great insights, Tim Baker. And I would point people, as you mentioned, to the YFP REI podcast, and you can reference episodes there, more information about the podcast. Also, if you go to yfprealestate.com, in addition to getting the podcast, you can download the Pharmacist Guide to Real Estate Investing. You can find an investor-friendly agent. And just, again, a shout out to David Bright, Nate Hedrick, that are doing a bang-up job, I think, on the YFP Real Estate Investing podcast, bringing education around real estate investing that's customized to the pharmacy professional, I think in a realistic way, right? I think they do a really nice job of talking about both the advantages of real estate investing as well as the realities of some of the risks and maybe the less talked about things in terms of some of the headaches that can come with real estate investing as well. So shout out to David and Nate for the work that they're doing. And Jonathan, again, thanks for your question. Thanks again for listening to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist podcast. If we feature your question on the show, we'll send you a super comfy YFP t-shirt. You can submit your question by sending an email to info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask-YFP. If you don't feel comfortable sharing your name on the show, you can send or record your question anonymously. As we conclude this week's Ask a YFP CFP episode, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this show. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the podcast and have a great rest of your week.